Nvidia just reported another record quarter. Revenue more than tripled to 18 billion and gross margins increased 20% year over year to 74%. Despite the impressive quarter, Nvidia stock actually fell and is down 4% on the week. That means Nvidia now has a market cap just under $1.2 trillion. It's got $18 billion of cash on the balance sheet and $11 billion of long-term debt. Revenue over the last 12 months is now $45 billion. That's 64% higher than at the same time last year. And net income is running at $19 billion, roughly 200% higher. So why did the stock drop? The first reason is valuation. Based on the latest numbers, the company is valued at 26 times revenue and over 60 times earnings. That's steep. If you bought the whole company today and earnings stayed flat, it would take more than 60 years to break even on your investment. The second reason is political. Government restrictions mean that Nvidia is prohibited from selling its most advanced chips to China. China revenues currently make up 22% of the total, so that could be a block on future growth. And if you look at quarterly growth rates, you can see some evidence of a slowdown. Revenue growth dropped from 88% in the second quarter to 34% this quarter, and based on company guidance, next quarter growth will drop again to 10%. Meanwhile, there's competition coming from the likes of AMD, and job postings confirm that large companies like Microsoft and Apple are beginning to design their own custom GPUs. Despite those risks, Nvidia's leadership is entrenched, and the company's latest chip, the H200, which will be released next year, is said to be twice as fast as the previous H100. CEO Jensen Huang is certainly optimistic. In a recent talk, he said we are barely at the beginning of the second wave of AI development. The third wave, which will be the use of AI in heavy industries, is barely getting started and could be the largest wave of all. Considering Nvidia's position at the forefront of AI, there's an argument that analysts are still underestimating the company's growth. Include next quarter's guidance and Nvidia revenues could hit 100 billion next year. Assume they grow 30% the year after that, and then 25% the following year, and Nvidia revenues could run to 160 billion in 3 years' time. With a net income margin of 30%, the company would then be producing 49 billion of net income, and a 35 times multiple would put the valuation at 1.7 trillion. That works out to an investment return of 13% per year. That's not bad when you consider Nvidia's current net income margin is much higher at 42%. In other words, unless real competition emerges, Nvidia shares can continue to march higher, which is why I give the stock a bullish rating. But these are my personal opinions, not financial advice. I currently hold no position in Nvidia stock, but I may take a position in the near future. For more investing videos, visit my website 3minutebreakdowns.com. And thank you for watching.